Today, we are diving into a massive economic showdown. Back in August of 2025, the US made a huge bet against India's economy, hitting them with some pretty crippling tariffs. The goal? To bring the rising power to its knees. But what happened next? Well, it defied every single expectation and might have just redrawn the entire map of global trade. So let's break down how India didn't just survive, it actually thrived. So the stage was set for a pretty traumatic confrontation. The US administration, feeling confident in its spot as the world's biggest market, predicted a swift crisis for India. The thinking was pretty simple: apply maximum pressure, and India would have absolutely no choice but to fold. And this slide, wow, it just says it all, doesn't it? On the left, you have the prediction from US advisors in August 2025. Give it 2 months, this country will be on its knees. Then look to the right. That's the reality just a few months later. A jaw-dropping 19.4% jump in goods exports, hitting a 10-year November high. So how on earth did we get from that dire warning to this incredible result? The US strategy was, pretty straightforward. The action? A huge 50% tariff on a whole range of Indian goods. The premise was that India, just like other countries before it, would crack under pressure from the world's largest market. The expectation was an economic crisis that would force India right back to the negotiating table, ready to give up some major concessions. It was a really bold, really aggressive move. But then the November data came in, and let's just say it didn't just challenge the narrative, it completely rewrote it. The numbers painted a picture not of a country on its knees, but of an economy just firing on all cylinders. All right, let's start with the headline number. While the US was expecting a total collapse, merchandise exports actually grew by a staggering 19.4% year over year. Now, this wasn't just some minor uptick. It was the highest growth rate for a November in a whole decade. A crystal clear sign that the bet against India was seriously backfiring. And the momentum, it didn't stop there. Total exports, that's combining both goods and services, hit a massive $74 billion for the month. That's a powerful 15.5% increase from the year before, showing real strength across the entire economy. And now for what is maybe the most critical number of all, the overall trade deficit. That's the gap between what a country imports and what it exports. Well, it shrank to just $6.64 billion. This was a 5-month low, and it signaled that India's economic foundations were actually getting stronger, not weaker, under all that pressure. This slide here really puts it all into perspective. You can see the record exports and, maybe most importantly, that dramatic plunge in the trade deficit. Every single key metric was pointing in the exact opposite direction of that initial dire prediction. So what was the secret? Well, a big part of the answer is right here. It's the engine running just below the surface. India did run a merchandise deficit of about $24.5 billion, but look at that huge orange bar. That's a powerful $18 billion surplus in the services sector. This surplus acted like a massive counterbalance, dramatically offsetting the goods deficit and just showcasing a super resilient and balanced export economy. And this wasn't just 1 or 2 sectors getting lucky. Nope, the growth was incredibly broad-based. Out of the 30 major export sectors they track, a full 25 of them showed positive growth. Electronics were up a massive 39%, pharmaceuticals up nearly 21%, and engineering goods up 25%. This tells you it was a widespread, systemic economic expansion. So how did India pull this off? Well, it wasn't an accident. It was the result of a 2-pronged strategy that combined this incredible resilience in its core markets with a really savvy and aggressive diversification into new ones. Okay, now for the ultimate rebuttal to the US strategy. As you can see on this chart, right after the tariff hit in August, exports to the US did dip for a little bit. But then look what happened in November, a massive 22.6% surge. The market adapted, supply chains stabilized, and it proved that the US demand for Indian goods was so essential that even a huge tariff couldn't stop it. Part of that essential demand comes from what we can call unbreakable links. The US couldn't just slap that 50% tariff on critical sectors like electronics and pharmaceuticals without causing massive self-inflicted damage. Think about it. The deep integration of Indian manufacturing into supply chains for companies like Apple and the heavy US reliance on Indian generic drugs to keep healthcare costs down, it made these sectors basically untouchable. But India didn't just hold its ground with the US, it went on the offensive.
This map shows how Indian exporters aggressively went out and captured new markets, turning a potential crisis into a strategic diversification. Exports to Spain exploded by over 181%, to China by 90%, and Hong Kong by over 35%. And the crucial point here is this. The US market is important, for sure, but it is no longer the only option. The consequences of these numbers, they go far beyond just a single month's trade data. What we're actually looking at here is a fundamental shift in the balance of negotiating power. It's creating a brand new reality in global trade. This visual just captures it perfectly. The US tariff shock on one side of the scale is being totally outweighed by Indian resilience on the other. And this has three key effects. One, it proved the resilience of the Indian economy. Two, it exposed the US's strategic dependencies. And three, most importantly, it fundamentally strengthened India's bargaining power in all future trade negotiations. And that new bargaining power is about to be put to use. India is holding a European ace. On January 26th, India and the European Union are set to sign a landmark free trade agreement. This is a game changer. EU companies are going to get preferential lower tariff access to the world's fastest-growing major market, giving them a huge first-mover advantage. Which means the clock is now ticking for Washington. That old maximalist approach, demanding full market access from India while offering very little in return, that's just not going to fly anymore. The consequences of doing nothing are severe. U.S. companies risk getting locked out of key sectors as Indian consumers build loyalty to those tariff-advantaged European brands. And the U.S. risks strategic isolation as India and the EU build this new trading bloc. And this quote just drives the point home perfectly. Once a consumer choice is made, it is not easily replaced, even if America enters the market later. In a booming market like India, being first is absolutely critical. And right now, the EU is poised to grab that advantage. This EU-India partnership, it really represents more than just a trade deal. It's the beginning of a potential new path for global trade, a real alternative to the dominant models we've seen in recent years. This slide perfectly illustrates the new global landscape. You have US protectionism on one side and Chinese mercantilism on the other. But the EU-India model proposes a third way, a collaborative network built on shared values and mutual market access. It's a pretty compelling alternative for nations that want to avoid being dependent on either superpower. So to sum it all up, India is now holding a winning hand built on three powerful pillars. First, proven resilience. The economy has shown it can withstand direct economic pressure from a superpower and come out stronger. Second, strategic diversification. India successfully pivoted its export engine, which reduced dependency and opened up whole new avenues for growth. And third, unprecedented leverage. Armed with compelling data and a powerful new EU partnership, India now gets to negotiate from a position of undeniable strength. And all this leaves us with a final, crucial question. The narrative has been completely flipped on its head. It's no longer about if India will buckle under pressure, but rather, how will other global powers, especially the United States, adapt to this new economic reality? Because one thing is absolutely clear. The game has changed.